You know, it's interesting about this. The big beautiful bill. Is that what it's called?
The big beautiful bill, which is it bills like that where they called you Patriot Act, like the Patriot Act. Well, it means if I don't agree with it, I'm unpatriotic. Yeah. Is that
or the Inflation
Reduction Act?
Yeah, the Inflation Reduction Act. There's nothing in there about reducing inflation. It's a big spending bill. Why don't we? I mean, the Congress wonders why their approval rating is so low, right?
We
mislabeled everybody. Yeah.
We not only that, we put lipstick on pigs all day long. That's what.
Yeah. Well, and why is our approval rating 17%? Gee, I wonder. Anyway, the big beautiful bill. One big beautiful bill act. Is that what it is?
You got to give them credit, though. You can't.
Okay. Regardless of how you feel about it, in that package, there's nothing about balancing the budget there.
Oh, far from it.
So unless we have some screaming economy the next several years,
which supposedly is going to be the fix.
Okay, that's what the big beautiful bill is designed to do. To have this, yes. I mean, it would have to be an economy similar to what we had in the '90s, the latter part of the '90s, particularly, right? In order for us, because we can't, just like our families, we can't keep spending more than we bring in every year. At some point in time, you're going to run out of credit.
Yes. And now they're talking about timing the market of when to issue debt, either short or long term, based upon where interest rates are, rather than a predictable manner.
Yeah, they're talking about just doing all short term debt to wait till the rates come down.
Yes.
And even if the Fed's lower, even if Trump, beats on Powell to the point where, which is a whole bizarre thing. Do you see when he just ridiculed him about the cost of the? Whatever you think about Powell or think about Trump, I mean, watch that whole thing. Like, I probably would have resigned if if someone did that to me. Anyway,
I don't think you'd have the patience to be the Federal Reserve.
No, are you kidding me? It sounds like a terrible job.
The Federal Reserve Chair.
Yeah, it sounds like a terrible job.
Yes. Yeah.
Anyway, open market committee, get everyone's opinions and all that, and then you got to come to consensus. No one agrees.
Consensus in an organization? Are you nuts? Okay, keep
particularly
going.
about the future of the economy,
like anyone knows.
Like anyone knows, right? So, back to Social Security, and Medicare.
Yes.
Like, if for good financial planning, for financial security, it's best that you plan
that there will not be Social Security there.
Best that you plan there's no Social Security, and best that you plan that you're going to carry a bigger portion of your medical costs.
Yes.
I mean, in a perfect world, perfect environment, you get to retirement, you have sufficient assets such that if Social Security is not providing you an income and you have to share the burden of your medical costs, that you've got the assets to do that. And if Social Security keeps coming in the way it's been coming and Medicare still covers the vast majority of your expenses, then you're like, wow, this is good. I don't have to worry about it. That's a bonus. But I think that's probably where place you'd want
to be. If your net worth is even moderately high, don't plan on Social Security. My wife, when she turned 62, I don't know if she's going to appreciate me saying this, but that's how old she is. We got Social Security check last month. She was telling me.
Oh, is that right?
Yeah. Kind of a hitter.
You're feeling pretty good about it.
Kind of a hitter. My wife hasn't been in the workforce for years and years, so the check was not very large. In the workforce. Didn't say she didn't work.
Yeah.
She has not been in the workforce. She works plenty hard.
My wife stayed when she was pregnant with her first child. She decided to stay home and raise kids, and she never went back into paid work. And every few years you get the Social Security. I could see like she did jury duty a couple times. That's the only wage she's had in the last 29,
well, you never
30 years.
thought about that. There would be tax withholdings on jury duty.
It's tax.
But I did this big, beautiful bill, Scott, back to this. It made your tax return so much more complicated.
Oh.
So much more complicated, right? Fortunately, technology will consume a lot of that, but made planning even harder, more
Correct.
difficult around it. I was reading about the charitable contributions.
Yes.
Did
So
you read
complicated.
this? It
Yes.
was so complicated. I was a hard time tracking, and I have a fairly good understanding of how this works.
It gets complicated in a few different ways.
The limits.
One is the SALT cap that went from 10,000 to 40,000. That's actually not going to impact that many people because there's a phase out. So the people that pay the higher state and local taxes are the higher income people.
Yes,
and that's going to end up phasing out. So
it doesn't matter.
Giving it to you in one hand and taking it away in the other. On the charitable deduction, your charitable deductions are only if you itemize and are in excess of 0.5% of your adjusted gross income. So if you made, let's say, $100,000, your adjusted gross income is $100,000, and you give $600 to charity, well, you don't get to take a deduction on the first $500. It's only that last
100.
Now, that might not have been a fair example because they did throw in there, in addition to itemized deductions,
They called it cash.
Is this in 2026 or
I don't
7?
remember what year it was, but they called it the
Didn't start
cash
this year.
contribution.
You can make a contribution even if you don't itemize. And I think it's $2,000 deduction if you're married and $1,000 if you're single. But if you're, let's say this is the year, this begins next year. So there's a lot of planning this year, but set up a charitable remainder trust or at a big transaction, you want to give a bunch of money that year. Your charitable deductions are going to have to be in excess of 0.5%. Number one. Number two is the top tax rate. So the current top tax rate is 37%, but you're only allowed to take a deduction at 35% equivalent. So there's some limitations on that.
Which made it just so much more complicated, which is if you're doing charity, you're, first of all, the best place ever to take it is in your required minimum distributions, right? That by far.
Maybe.
Right? Or you bulk it.
Yes. So right now, I mean,
Or you bulk it.
Less than.
And explain what bulking means.
Well, first of all, I think it's 11% of Americans itemize deductions. Most have taken the standard now because
it's so high.
Yeah. Standard deductions are so high. And let's say that's you. And you might have significant assets and all that, but just the way things work, you've been itemized. And let's say you like to give X dollars a year to your charities or church or synagogue, whatever it is. Rather than do it on an annual basis, maybe you do 3 years worth of contributions in 1 year to a donor advised fund. And then from there, over the next couple of calendar years, you make your contributions to these charities. It accomplishes the objectives that you had anyway, and it provides you a tax benefit in the current year when you bunch these together.
And it allows you to get rid of some of your highly concentrated positions, right? Because you can actually take the shares themselves and move it in to the donor advised fund.
Yeah.
So if you've got highly concentrated positions, it all works out into this program.
And this year, if you are planning some charitable contributions, you're going to want to seriously look at doing some things in 2025 and not pushing to 2026. That was just one example. But let's say you're a small business owner with a pass-through entity, an LLC or S Corp or something, and you get some additional benefits that phase out at higher income levels, and you're trying to balance that and the Medicare premium tax, and you do a Roth conversion because you're nearing retirement, and the charitable reductions and the SALT limitations.
It makes planning that much more difficult. It makes it did not do anything to even slightly simplify the tax code, which was, if you remember 6, 7, 8 years ago, it was we need to simplify the tax code. That never came up.